Hello, everyone. This is Dana from NexGen, and welcome to Me Inc. I hope everyone has had a wonderful week. We've been talking about so you want to buy a house these past few months. And last week we did a pretty much a one-on-one with Millennial Mogul Ariel to basically go through the steps of what you can expect when you're purchasing your home. And we also talked about specific terms that we needed to know what they meant. So we did a lot of them last week, and then the weeks before that, we had our Holland's Home team that told us about the process, and we also had a mortgage lender that gave us some information. So I'll be linking that above and in the description below. But Rocket Lawyers, or one of the articles I read, said that a lot of home buyers didn't know the definition of terms. And one of the big ones was amortization. A lot of people didn't know what that meant or had even seen an amortization table. So an amortization, if you looked earlier in the video, is pretty much a snapshot of a loan. And it talks about specifically the principal and the interest. But I will tell you that a loan is actually more than that. So what I'd like to do is talk about what's going to happen at closing, the information that you're going to receive, and then actually show you what an amortization table looks like. All right, so when you go to closing, and this is pretty much where you're going to be getting the keys to your new home. So on this example that I'm going to show you here, these are actual real numbers that I'm using, and I'm using it for a home that was purchased by a veteran using their benefits. And what I mean by that is there's different ways that you can purchase your home. So today we're talking about VA, we're talking about FHA, we're talking about conventional, or you can pay the property out in cash. So there's different ways that you can do it. I'm just going to give you an example of one that was used by a veteran. Now, the significance of that is that for this veteran, they're not going to pretty much come out of pocket. Whereas with other lenders, you may have to put a certain percentage down. So, and the other thing is that there's no private mortgage insurance. So this is the example that I'm going to be giving you today. So on this particular property, there was an offer of $386,000 and it was accepted. So part of the VA process, well, the lenders, when they're using a VA loan, is that they are only going to loan what is at the appraisal or lower. They're not going to be paying for more than what it's appraised. So in this scenario, it would be safe to say that the home value is at least $386,000. Now, this buyer also gave a earnest money deposit, I believe, of $3,800. So even though they used their VA, they used a VA loan, they submitted an earnest money deposit of $3,800 with their offer. So to be clear, that was money out of their pocket because it was deposited. Now, it will be included as part of the payment, so they're really not out that money. If for some reason the deal does not go through, they will get their earnest money deposit back if they're in compliance. So just make sure I'm clear on that. Now, some of the other things that you may see on what they call an ALTA, it's a form and it's basically a snapshot of everything that the seller is going to pay and everything that the buyer is going to pay. And it's pretty much one either long sheet or two 8x11 sheets. So it's basically a snapshot of what the buyer's going to pay and what the seller's going to pay. So the sales price is $386,000. They do take into account what was provided by the buyer as an earnest money deposit to say, hey, I'm serious about getting this house and I'm doing this to get your attention. The seller is also going to be paying part of the closing costs, and I'll talk a little bit about that in a minute. So the seller would be paying for the commissions of both the buyer and the seller's agents and some other things. And the buyer is going to pay a funding fee. That is only for those loans that are using VA. So that's something that's very important. Also, they're going to be paying a portion of the homeowner's insurance and also property taxes and any other taxes. So let's say that this tax year begins in June of, let's say, 2020, and the closing doesn't occur until January 2021. The buyer will be responsible for the taxes from the date that they take possession of the property, which is January 2021, till June of 2021. So they're actually going to get a prorated amount that they're going to be paying. Also, they're going to be paying a prorated amount of the homeowner's insurance. Now, remember, the buyer is responsible for selecting the homeowner's insurance. Now, there's a lot of other closing amounts that are going to need to be paid, and that will all be put on the settlement statement. And that's one of the reasons why the mortgage lender has to have 3 days to review it. So they want to make sure that everything is in compliance. So for the property that was appraised at $386,000, and with the exception of maybe the earnest money deposit, the veteran home buyer did not come out of pocket. However, the new loan is $411,745.83. Now, this information is accurate. So you're going to say, okay, so that's good. Now, remember, it was appraised at least $386,000. So what I'm going to do is show you why looking at an amortization table is going to actually be to your benefit. Okay, let's go ahead and go to the loan amortization schedule. Now, this is a spreadsheet that you can get from Excel, and also the lender, a lot of lenders have an amortization schedule when you go to log in for your account. So this is just pretty much a snapshot of your loans, principals, and interest. It does not include the escrow, and I'll show you what I mean by that in a second. Okay, so the loan amount is not what the property was purchased for. The loan amount is $411,000, 745.83. So that is the actual loan amount. And then the annual percentage rate is 3.375. Now, that's what it was at the time the loan was. It's a fixed loan. And if you remember me talking about locking in the rates from the previous video, when you lock in a rate, that was the rate at the time the application was done, and the buyer chose to lock in the rate. So if the rate changed to a higher amount throughout the loan process, it would still remain at the amount that it was locked in. So this person actually locked it in at 3.375. So with that, it's a 30-year fixed, and they're paying every month. And so that it shows that the principals and interest payment is $1,820.31. So again, that is not the total payment. Let me show you what the total payment would be. But before we do that, let me go ahead and remind you of what the appraised value was and the purchase price. Okay, that was the amount. Now the escrow is comprised of, because this is a VA mortgage, is going to be the homeowner's insurance, not to be confused with the payment principal, the PMI insurance. This is homeowner's insurance. So that was $1,200. And for the taxes, it was $6,000. That is per year. So what the lender is going to do is they are going to estimate, usually in an upward position, they're going to add the annual payments for the insurance and the taxes and divide it by 12. So if you add the insurance and the taxes, which is by the year, is going to be 7,200. So you'll take the 7,200 and then divide it by 12. So that would give you a $600 a month escrow. And with that added to this scheduled payment, it will give us the new, okay, that would be the new payment. So with the principal and interest, it's this amount, but when you include the escrow, it is this amount, the $2,420.31. Now, keep in mind, even though this amount is fixed and it's based on the fixed interest rate, just know that the new payment can change because it's based on the taxes and insurance or the escrow. So let's take a look at the payment number one. So we're going to start out with this as the beginning balance. Now, as I said before, this is not the scheduled payment. It's actually going to be this amount here. And then you're going to see this amount is applied to the principal, and this amount is applied to the interest. So the only way that this amount can be reduced is to increase the principal only. And then the interest will be from the next balance. So as you can see, the loan amount is almost $412,000, where the appraised value was $386,000. So if we were to go off of the equity, and that's assuming that this is the value of the home, we're actually in a negative equity situation at the beginning. But this is the buyer's home, so they're not really concerned with that. They're comfortable with the new payment, and they know that it can be adjusted based on the insurance and taxes. So let's look at the payments and see when it actually will get close to the appraised amount. Now, keep in mind, this appraised amount is fixed in time. So this is what it was appraised at the end of 2020. So let's see. Now, we'd like for it to increase in value. Sometimes it happens and sometimes it doesn't. But it looks like we're not going to get close to the 486,000 until February of 2024. And that's if the buyer is making the regular scheduled payments. They can make more, but that's usually where we're going to see that they're going to get to the close to the appraised value. Now, keep in mind that the principal payment is still lower than the interest, and we won't see it changing until, let's see, I'm not going to see that changing until maybe, let's see, I want to see 2030. So that's when you're going to see where more is going to be applied to the principal than to the interest. So if it's a 30-year fixed mortgage, then it's going to be paid off December 1st, 2050. Of course, like I said before, the buyer can pay more of the principal. Now, a lot of times, what I've been reading in articles is that they've been refinancing their mortgage or they purchase another property. Now, one of the things that I will say is if that buyer refinances now, then the interest rate is going to be a lot higher than it is right now. And then keep in mind, if they refinance, there's going to be other fees that are going to be added on to their principal balance. So this is the reason why it's so important to look at the loan amortization schedule. And if people usually refinance or purchase a new home within 7 years, that's why in previous videos I talk about it being where you would pay more of the principal, that the house will be paid off sooner, so that you'll actually be in a better financial position if you decide to either refinance or if you want to purchase another property or you want to move or something like that. So this is why it's very important for you to look at the loan amortization schedule, and then look at the ending balance, and keeping in mind that when the ending balance is more than the appraised value, whatever that may be, you would be in what we call a negative equity situation. And at the point where it actually is going to be more than the appraised value, then you would find yourself in a positive equity. You'll have more equity, if you will. So that's why it's important for us to take a look at the loan amortization schedule so that you can make a better informed decision. And now you know what it looks like. You can use this for just about anything, but I choose to use this for purchasing a home or property where I'm going to actually have a loan. I hope this information was beneficial to you. Now you have more tools in the toolbox, whether you're purchasing a property or a home, or whether you're refinancing. This way, you're making an informed decision.
Make sure to like and subscribe and hit the notification bell so you can never miss another video.